Global financial markets were jolted this week after intense debate erupted online and across trading communities following a sudden trading disruption and regulatory adjustments in the precious metals market, particularly silver. The controversy gained momentum after market participants and independent analysts claimed that trading conditions were altered during a period of heightened volatility, leading to accusations that the rules of the market were changed mid-game to protect large institutions while disadvantaging retail investors. Silver prices had been moving aggressively amid strong demand for physical metal, rising geopolitical uncertainty, inflation concerns, and growing skepticism about paper-based financial instruments. Retail investors, hedge funds, and institutional players were all active as volume surged. As price momentum accelerated, exchanges reportedly implemented measures such as higher margin requirements, trading pauses, or liquidity controls designed to stabilize market conditions. While such actions are permitted under existing exchange rules, their timing and impact immediately drew criticism. Many retail traders argued that these measures effectively stopped upward price movement by forcing smaller participants to either add capital or exit positions, while larger firms with deeper reserves were able to absorb the changes with ease. Social media platforms, online forums, and video commentaries quickly filled with claims that the system was manipulated, with critics asserting that exchanges and financial institutions acted to prevent further price discovery that could have exposed vulnerabilities in the paper-silver market. Market veterans countered these claims by emphasizing that margin increases and temporary trading halts are standard risk management tools. Exchanges routinely adjust margins when volatility spikes to protect clearinghouses from default risk. Supporters of this view argue that without such safeguards, a disorderly market could threaten broader financial stability. They point out that similar actions have occurred across commodities, equities, and derivatives markets during periods of extreme price movement. Nevertheless, the episode reignited long-standing concerns about transparency and fairness within commodity markets. Silver, in particular, has a history of controversy, with repeated allegations over the years of price suppression, excessive short positions, and discrepancies between paper contracts and available physical supply. Analysts note that futures markets allow large volumes of silver to be traded without immediate physical delivery, which can amplify price swings and fuel distrust among investors who favor tangible assets. Industry data shows that demand for physical silver has remained strong, driven by industrial use, renewable energy technologies, electronics manufacturing, and investment demand from individuals seeking a hedge against inflation and currency depreciation. At the same time, inventories at certain exchanges and vaults have been closely monitored by traders, adding to speculation that supply constraints could intensify volatility. Regulatory bodies have so far maintained that markets are functioning within established frameworks. Officials emphasize that exchanges are obligated to manage risk and ensure orderly trading, particularly during periods of rapid price changes. They stress that rule adjustments are not designed to favor one group over another, but rather to maintain confidence in the financial system as a whole. Despite these assurances, trust among retail investors remains fragile. Many argue that repeated interventions undermine free market principles and discourage participation by smaller investors. Critics say that when price movements threaten major financial players, safeguards are quickly deployed, while losses borne by everyday traders during downturns often receive little attention. Financial experts caution that emotional reactions can amplify uncertainty. They urge investors to distinguish between confirmed regulatory actions and speculative narratives circulating online. Market structure, they note, is complex, and short-term disruptions do not necessarily indicate systemic failure. Long-term price trends in commodities like silver are influenced by a combination of supply, demand, macroeconomic conditions, and investor sentiment. The broader implications of this controversy extend beyond silver alone. It highlights the ongoing tension between market stability and open price discovery in modern financial systems. As technology allows information and opinion to spread instantly, public scrutiny of financial institutions continues to intensify. Calls for greater transparency, clearer communication from exchanges, and more consistent regulatory oversight are growing louder. In the days following the disruption, trading activity stabilized, though debate continues. Some investors see the episode as confirmation of structural weaknesses in paper-based markets and have increased their focus on physical assets. Others view it as a routine, if uncomfortable, reminder of the risks inherent in volatile markets. Ultimately, the situation underscores a fundamental reality of global finance. Markets are governed not only by supply and demand, but also by rules designed to manage risk. When those rules are activated during moments of stress, perceptions of fairness can be challenged. Whether this event leads to meaningful reform or simply fades into the long history of market controversies will depend on transparency, regulatory response, and the ability of institutions to rebuild trust with participants at every level.